Hello and welcome to Week in Markets. Today I'm joined by Lexi Herriott, investment analyst, who's going to help talk us through the key events of the week and how markets have responded to that. So Lexi, I suppose inflation has been the key event for this week, and there's even more focus on inflation today than ever because of tariffs and what tariffs mean. Tariffs increase the overall level of prices, so that should come through in the inflation data. Has it yet?
Yeah, so headline inflation for the US rose slightly to 2.9%, which was a bit higher than expected. But if you look at core inflation, which excludes volatile items like food and energy, that was unchanged at 3.1%, which was expected. So this really shows that the tariff impact is more controlled than feared, particularly if you look at underlying goods inflation, which only ticked up slightly, as that's something we're monitoring as it's more affected by tariffs.
So inflation broadly in line with what investors were expecting. And also it is important to look at that durable goods component, which shows that tariffs are having some effect but quite limited, which is positive news. Services inflation remaining sticky, about 3.6%. I suppose, so we've had the inflation data. We also had labour market data as well, which has been certainly in focus over the last couple of months, where we've seen some cooling. What was the data this week?
So this week we had jobless claims, which is a timely indicator of the labour market and shows the number of people claiming unemployment benefits on a weekly basis. Yeah. So this increased for the first week of September, which, along with the weaker jobs data in August, jobs growth data, it sort of shows weakening labour market, further signs of that.
Yeah, and I suppose it's the number of people claiming unemployment benefits, whilst it is timely, it can also be quite noisy. So it's worth bearing that in mind, but certainly taking that and the jobs data at the end of last Friday, it does show that the labour market is cooling, which is quite interesting as we look ahead to next week, where we'll have the Federal Reserve, the US Central Bank, deciding on interest rates. What do you think the data tells us about the direction for interest rates going forward?
Yeah, so next week the market's expecting a 0.25% interest rate cut, as the Fed is more cautious on inflation to start with. But over the rest of the year, over the two meetings, they're expecting 0.5% interest rate cuts as they focus more on the cooling labour market and try to control that.
Yeah, there certainly feels a bit more reassurance that they are and have the data to support lowering interest rates, not only next week, but in the coming months as well. And that's certainly what the markets are pricing. So we've looked at the US, largest economy in the world. We're also looking at the second largest, which is China, as they've been reporting their inflation data this week. How would you contrast the two?
So China is firmly in deflation, so they're actually seeing declines in producer prices and consumer prices due to weak demand and excess capacity. So they're really trying to focus on the downside risks with their policy rather than stimulus in China.
And it is quite interesting in China, which, while it's still benefiting from exceptional export growth, if you look at domestic growth and the consumer demand, it remains quite depressed. They've been through a housing crisis, and that's had a knock-on effect onto consumer sentiment, and really to drive improved confidence is really quite difficult. So they are putting in certain measures to help do that, but it's still not quite paying dividends. Okay, so we've looked at China, we've looked at the US. Yesterday, we've also had news from Europe with the European Central Bank. Any interesting developments?
No developments. They kept rates unchanged, but they have been reducing interest rates over the last year. The outlook was also broadly unchanged, with inflation close to target. Growth okay, it's still quite low, but there are some signs of improvement, but we're still yet to see the impact of Germany's fiscal stimulus there.
Yeah, there's a real contrast in terms of what we're seeing in Europe, where inflation is around the 2% inflation target, whereas here in the UK, inflation is much higher and is expected to get to around 4%. And if you think about it, in the US, we've got inflation around 3%. So that more benign inflation environment has allowed the European Central Bank to cut interest rates quite aggressively this year, and so are already in the position where they don't need to lower interest rates further right now. Okay, so quite a lot of developments there. How has the market responded to this?
The market reaction's been really positive. World equities so far this week are up 1.7%, but it's not just in the US that we're seeing strong equity performance. Japan and emerging markets are also performing really well. But we are multi-asset investors, so we need to consider other asset classes other than equities. So bonds, both sovereign and corporate, have had positive returns, as well as gold. So this is really good for us as multi-asset investors and our portfolios.
It's quite interesting, there's often a lot to be fearful of, whether it's inflation, tariffs, but equity markets continue to grind higher, new all-time highs for the US again this week. So it just shows the importance of being invested, but having the benefits of being diversified across different asset classes can help smooth out that journey for you. Thank you very much, Lexi, and thank you all for watching. We'll see you next time.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.